In the late 1990s, when the internet was transforming from a curiosity into a necessity, a charismatic entrepreneur named Gary Winnick had a vision that would make him billions and cost investors everything. His company, Global Crossing, promised to wire the entire world with fiber optic cables, creating a digital superhighway that would carry the planet's communications at the speed of light. At its peak, this empire was worth $47 billion. 5 years later, it would vanish in the fourth largest bankruptcy in American history, leaving behind a trail of accounting fraud, political corruption, and one of the most spectacular corporate collapses ever witnessed. Gary Winnick wasn't a telecommunications expert. He was a junk bond salesman who had worked alongside Michael Milken at Drexel Burnham Lambert during the 1980s, learning the art of high-stakes financial engineering before that firm imploded in scandal. But Winnick possessed something more valuable than technical expertise, an understanding of how to package dreams and sell them to investors hungry for the next big thing. In 1997, he founded Global Crossing with a deceptively simple premise. The internet was exploding, data traffic was doubling every few months, and the existing telecommunications infrastructure couldn't handle the coming tsunami of digital information. The solution was fiber optic cables, hair-thin strands of glass that could carry vastly more data than traditional copper wires. Even better, Winnick proposed laying these cables across ocean floors, creating a global network that would make him the master of international communications. The timing seemed perfect. Internet stocks were soaring, venture capital was flowing like water, and investors were throwing money at anything with a .com in its name. Global Crossing went public in August 1998, raising $750 million in what was then one of the largest initial public offerings in history. The stock price exploded from $19 to $87 within months, making Winnick a billionaire on paper. But unlike the software companies and e-commerce startups that populated the .com boom, Global Crossing was pursuing something far more ambitious and expensive, physically rewiring the planet's communications infrastructure. Laying undersea fiber optic cables required specialized ships, enormous capital investments, and years of construction before generating a single dollar of revenue. Each cable cost hundreds of millions of dollars and took 18 to 24 months to complete. Global Crossing's first major project was the Atlantic Crossing Cable System, a 2,700-mile fiber optic highway connecting the United States and the United Kingdom. The company promised this cable would revolutionize international communications by providing bandwidth capacity that was 50 times greater than existing cables. Wall Street loved the story, and Global Crossing's stock continued climbing as the company announced increasingly grandiose plans. They would build the Pacific Crossing to connect the US and Japan. They would create Pan-American cables linking North and South America. They would construct the Europe-India Gateway and the Blue Mediterranean cables. Within 5 years, Global Crossing claimed it would operate the world's first integrated global fiber optic network, carrying the majority of international internet traffic and generating billions in annual revenue. The financial engineering behind this vision was breathtakingly aggressive. Global Crossing didn't just build cables. It went on an acquisition spree, purchasing existing telecommunications companies and smaller cable operators to rapidly expand its network. In 1999, the company acquired Frontier Corporation for $11 billion, instantly gaining access to local telephone networks across multiple states. They bought IPC Communications, a European telecommunications company, for $3 billion. They purchased Cable and Wireless's internet assets and dozens of smaller firms. Each acquisition was financed through debt, stock swaps, or complex financial instruments that pushed Global Crossing's total obligations into the stratosphere. By 2001, the company had accumulated over $12 billion in debt while generating less than $4 billion in annual revenue. Behind the scenes, Global Crossing was pioneering accounting techniques that would later become infamous across corporate America. The company engaged in massive capacity swaps with other telecommunications firms, essentially trading fiber optic capacity on their respective networks. Here's how it worked. Global Crossing would sell $100 million worth of capacity on its Atlantic cable to another company, recording this as immediate revenue. Simultaneously, it would purchase $100 million worth of capacity on that company's Pacific cable, recording this as a capital expense that could be depreciated over many years. The net effect was zero, but Global Crossing could book the sale as current revenue while spreading the purchase cost across future years, making quarterly earnings appear far stronger than reality. The company completed over $3 billion of these sham transactions, artificially inflating revenue by enormous amounts. The capacity swaps were just one element of Global Crossing's accounting manipulation. The company also engaged in aggressive revenue recognition, booking long-term contracts as immediate sales even when customers could cancel with minimal penalties. They capitalized routine operating expenses as network investments, reducing reported costs and boosting profits. Most egregiously, Global Crossing created complex partnerships and subsidiaries that existed primarily to hide debt and inflate revenue through circular transactions. The company would sell network capacity to these entities, record the sales as revenue, then provide the financing for these purchases through convoluted loan arrangements. Arthur Andersen, Global Crossing's accounting firm, signed off on these practices, apparently seeing nothing wrong with transactions that had no economic substance beyond manipulating financial statements. While Global Crossing was cooking its books, the broader telecommunications industry was experiencing a catastrophic collapse. The dot-com crash of 2000 had eliminated many of the internet companies that were supposed to be Global Crossing's customers. Even worse, dozens of other companies had pursued similar strategies, laying massive amounts of fiber optic cable across the globe. The industry had built enough capacity to handle internet traffic growth for the next decade, but that traffic never materialized. Bandwidth prices collapsed as supply vastly exceeded demand. Companies that had paid premium rates for international connectivity suddenly had dozens of competitors offering the same service for a fraction of the cost. Global Crossing's revenue projections, which assumed continued exponential growth in internet traffic and premium pricing for fiber optic capacity, proved wildly optimistic. Gary Winnick, however, wasn't suffering along with his investors. Between 1999 and 2001, he sold over $734 million worth of Global Crossing stock, carefully timing his sales to avoid insider trading accusations while cashing out at peak prices. Other executives followed suit, selling hundreds of millions in additional shares even as they publicly proclaimed confidence in the company's future. Winnick used his proceeds to purchase a $247 million estate in Bel Air, complete with a golf course and helicopter landing pad, making it one of the most expensive residential real estate transactions in American history. He also acquired luxury homes in Hawaii and Martha's Vineyard, a private jet, and a collection of rare automobiles. Meanwhile, Global Crossing's employees saw their retirement savings evaporate as company stock, which comprised a major portion of their 401k plans, became worthless. The political connections Global Crossing cultivated added another layer of scandal to its collapse. Terry McAuliffe, chairman of the Democratic National Committee and close friend of President Bill Clinton, invested $100,000 in Global Crossing's initial public offering and sold his shares 2 years later for $18 million, an astronomical return that raised questions about political favoritism. The company hired numerous former government officials as executives and board members, including Donald Rumsfeld, who served on the board before becoming Secretary of Defense and reportedly earned $25 million from his Global Crossing stock options. The revolving door between Global Crossing and government agencies helped the company navigate regulatory approvals for its international cable projects while building relationships that would later complicate investigations into its business practices. By 2001, Global Crossing's financial manipulations could no longer hide the underlying business reality. The company was burning through cash at an unsustainable rate, debt payments were consuming most of its revenue, and the telecommunications market showed no signs of recovery. Bandwidth prices had fallen by over 90% from their peaks, making it impossible for Global Crossing to generate sufficient revenue to service its obligations. In October 2001, the company announced massive layoffs and began desperately seeking additional financing. Investment banks that had eagerly underwritten Global Crossing's expansion suddenly wanted nothing to do with the company. The stock price, which had peaked at over $60 per share, fell below $1 as investors finally recognized the scope of the company's problems. On January 28, 2002, Global Crossing filed for bankruptcy, listing assets of $22 billion against liabilities of over $12 billion. The bankruptcy was the fourth largest in American history at that time, exceeded only by Enron, Texaco, and Financial Corporation of America. The filing wiped out nearly all shareholder value, eliminated thousands of jobs, and triggered investigations by the Securities and Exchange Commission, the Federal Bureau of Investigation, and multiple congressional committees. Employees who had been encouraged to invest their retirement savings in company stock lost everything, while customers faced uncertainty about whether their telecommunications services would continue operating. The bankruptcy also revealed the full extent of Global Crossing's accounting fraud, as court-appointed investigators uncovered the web of capacity swaps, circular transactions, and revenue manipulations that had hidden the company's true financial condition. The aftermath of Global Crossing's collapse reverberated far beyond the telecommunications industry. Arthur Andersen, the company's accounting firm, faced intense scrutiny for its role in approving fraudulent financial statements, contributing to that firm's eventual demise following the Enron scandal. The Securities and Exchange Commission implemented new rules requiring more detailed disclosure of telecommunications industry transactions, particularly capacity swaps and revenue recognition practices. Gary Winnick faced multiple lawsuits from shareholders and employees, eventually agreeing to pay $25 million to settle claims while admitting no wrongdoing. However, he kept the vast majority of his profits from selling Global Crossing stock, demonstrating how corporate executives could extract enormous personal wealth even as their companies collapsed. Global Crossing's story represents more than just another corporate bankruptcy. It exemplifies how financial engineering and accounting manipulation could create enormous apparent value while destroying real wealth. The company's fiber optic cables weren't worthless. Much of the network continued operating under new ownership and eventually became profitable as internet traffic finally caught up with installed capacity. But the manic overbuilding of the late 1990s, financed through misleading financial statements and unrealistic projections, created a boom and bust cycle that devastated investors and employees while enriching a small group of executives and early shareholders. The $47 billion in market value that vanished when Global Crossing collapsed wasn't just numbers on a balance sheet. It represented pension funds, college savings, and retirement accounts of ordinary investors who believed in the promise of a connected world. The Global Crossing saga also revealed how the intersection of technology, finance, and politics could create powerful incentives for fraud and manipulation. The company's vision of a globally connected world wasn't wrong. Fiber optic cables did eventually carry the majority of international internet traffic, enabling the digital economy we know today. But the execution was fatally flawed, prioritizing financial engineering over operational excellence, stock price manipulation over customer service, and personal enrichment over sustainable business building. The executives who extracted hundreds of millions of dollars through well-timed stock sales left behind a bankrupt company, thousands of unemployed workers, and investors who learned too late that revolutionary technology doesn't automatically translate into profitable businesses. In the end, Global Crossing's fiber optic empire didn't vanish because the technology was flawed. It disappeared because the people running it prioritized getting rich quick over building something meant to last.